The recent market decline over the last year and a half or so has created a lot of stress for many investors. And unfortunately, too often we see investors panicking and wanting to get out of stocks altogether and move into treasury bills. And the central theme is treasury bills have never produced the kinds of real returns that most investors need. Or stated differently, if investors could invest in treasury bills and take no risk and maintain their standards of living over the long haul, why would they take any risk at all? Historically, treasury bills have done about 4% a year, while inflation has been about 3% a year, giving a positive real return of about 1% a year. That's assuming, of course, you don't pay taxes. If you pay taxes, probably your returns are close to zero or even negative. On the other hand, stocks have had real returns of about 6% a year. That obviously would allow for much greater consumption available from investing in treasury bills. Of course, that requires taking investment risk. So therein lies the planning problem. On the one hand, we need significant real returns to finance our retirement and maintain our standard of living, but we can't do that risklessly. To drive the point home, we can look at a couple of examples. Assume that you get a 4% nominal return, as in treasury bills, with a 3% inflation. And suppose you have $1 million and you want to consume initially $30,000 and maintain that throughout retirement. To begin with, assets are about 30 times the consumption, but over time that dwindles. In fact, after 40 years, the investor is totally wiped out. The reason for the decline is that investment returns are a real 1%, while consumption grows at 3%. The second plot shows an example for an investor that chooses to consume $50,000. The first one shows the decline in assets if there's a 1% real return, in which case the investor gets wiped out in 23 years. The second curve shows, well, what happens if the real return were 3% instead of 1%, in which case the investor gets wiped out after 30 years. And of course, the Treasury doesn't guarantee any real return at all. There have been long periods of time when real returns have been far from that. For example, an investor investing in Treasury bills at the beginning of 1933 would have had to wait for 65 years until he got the real value of real purchasing power back from his investment. Treasuries solve one kind of problem. It reduces investment risk, but it introduces another kind of problem, which is purchasing power risk. So let's work on making an asset allocation decision by considering various combinations of stocks and treasury bills. The chart in front of you displays the results for 6 different portfolio combinations from 100% stocks to 100% treasury bills. The index used for stocks is the CRSP index. CRSP stands for the Center for Research and Securities Prices. It's developed at the University of Chicago. The next 2 columns provide the summary statistics for those portfolios over the last 83.25 years. The real return from treasury bills has been 0.7% a year, or 70 basis points, where the real return for stocks has been 6% a year. The next column displays standard deviation, which is a measure of volatility, and as can be seen, the standard deviation for stocks is much greater than for treasury bills. But as we've been talking about real returns, there are many different ways of describing risk, and one way is just to look at various 10-year returns. The next column displays the worst 10-year experience for these various portfolio combinations. This is calculated by looking at the 900 or so different 10-year combinations using monthly data. Starting with treasury bills, you can see that the worst 10-year experience for treasury bills is a real return of minus 42%. That was the 10 years ending February of 1951. That's of particular interest to us now because over that time period, treasury bills returned less than 1% a year, while inflation was 6%. We are now back in a situation where we have treasury bills yielding less than 1%. Next, look at the results for stocks. The worst 10-year period in real returns for stocks was a minus 39%. And it turns out that was the 10 years ending February 2009. So it's not surprising that people are having a lot of concern about stock returns, having lived through the worst 10-year period ever. Looking at the chart then, it's surprising that in terms of real returns, which is what we really about, the worst 10-year experience for Treasury bills is worse than the worst 10-year experience for stocks. Using that measure of risk, one would conclude that Treasury bills are riskier than stocks. So we have two different conclusions about risk and return based on how we measure risk, whether we use volatility or we look at purchasing power. In terms of worst 10-year experience, the best outcome is really for the portfolio that's 40% invested in stocks and 60% invested in Treasury bills. What I conclude from all of this is that it's not surprising that most investors choose a portfolio mix of 60 or 70% in equities. Over the long haul, they'll provide the